Hi, everyone. This is Rob Barnett from Bloomberg Intelligence, and I'd like to welcome you to today's BI Energy Exchange, where we talk about our research and the latest developments in energy markets. I'll quickly run around the room here. We've got Salih Yilmaz dialed in from Dubai. We've got Will Hares and Patricio Alvarez over my shoulder here in London, and we've got Fernando Valle from our office at 731 Lexington in New York. So I hope everyone is doing well. If you haven't been paying attention to the headlines, Germany has decided long ago to shut down its nuclear power plants, and the final three, I believe, closed this past weekend. I think there's broad discussion that can stem from this, and for the first part of today, I want to come over to Patricio Alvarez to get your read on this fairly momentous decision point, and what's your take on the next 12 months of Germany's kind of gas and power markets without nuclear in the mix? We've just come out of a pretty tumultuous year with the gas market over here in Europe. Does this really factor in, or how do you see the next bit going?
So thanks, Rob. I think a good way to look at it first is give context of what the gas situation is doing in Germany. I think considering that demand during this past winter fell approximately 18% versus the previous year, that gives you sort of what it took for Germany to surpass the energy crisis and somewhat liberate itself from Russia's apparent weaponization of energy. So on that front, what the removal of these three last reactors this past April 15th will do is it's perhaps reduce the scope for flexibility. Before shutting the reactors, nuclear power accounted for about 10% of German power generation. So it's not a huge blow. But given that the gas supply outlook is still very much frail, given that LNG facilities are only partly abating the loss of Russian gas flows, which are now virtually zero going through Germany. That means that any sort of shortfalls in wind and solar or any sort of spikes in peak demand will need to be met with coal-fired generation, which I think is a great a great place sort of to open up the discussion on why is Germany giving up an emission-free source that is reliable, is by far the highest, that has the highest efficiency factor amongst power generation technologies, and now it's replacing it by perhaps the heaviest emitter amongst all technologies, which is not even hard coal, but lignite, which is the brown coal, the bad stuff that is still pretty much, I think, in the political balance in Germany, and that's sort of sparking the debate again of how is Germany gonna weather sort of this fast energy transition, wind and solar, and with very little flexibility on the other end. No base load, so they don't have a lot of hydro. There's not nuclear anymore, which means that there's still that sort of gap, I think, into like in years. Will this be gas that meets the flexible demand? Will it be hydrogen or a combination of both, perhaps batteries? But yeah, I think that gives you the outlook.
Very interesting. There was a great Twitter thread from a University of Chicago professor named Mike Greenstone, who kind of looked at this issue and made a very compelling case for nuclear being in the mix. But these are political decisions, and in some sense, they've been made. So if you sort of take on face value that coal's perhaps going to be around a bit longer, there can be this analog discussion of, okay, well, gas has traditionally been seen as a bridge fuel, a transition fuel, this kind of thing. I think the last 12 months maybe has upended that narrative a bit in the US, but given the exposure to a lot of the integrated oil and gas companies to this question, I want to get some input from the team on kind of where the Shells, BP, Exxons of the world are on this topic. So Fernando, we'll come to you first. With the closure of nuclear in Germany, is this an opportunity for gas, or do you think coal is going to sort of take the day for now?
I think it's an opportunity for both. There just aren't enough thermal coal plants around to fulfill all of the necessity, not just in Germany, but there are several other places that have taken similar steps, from Belgium to the Midwest in the U.S. So the cost of thermal coal is high. We'll need natural gas. Patricio mentioned that Germany's demand was down 18%. Part of that is because we had the warmest winter in 50 years in the Northern Hemisphere. Will we get that lucky again? So we'll need all of the above to if there's even an average winter. And then a lot of the inventory fill in Europe last year was Russian piped gas that is no longer available. So with the loss of not just Germany's nuclear, but Belgium's nuclear, and then we're losing Groningen, and we de facto losing Russia this year. Where does that leave us as far as flexibility? I think LNG is going to look very, very attractive for the next 5 to 10 years at least.
Will, how do you see it? Any divergence in opinion when you look at the European oil majors?
I mean, certainly when you look at what Germany is doing on LNG import facilities, there was a frequent criticism, in the height of Europe's gas crisis, that Germany was one of the only major European countries to not have a single LNG import facility, which of course exposed the country to these gas shortages, and particularly when you compare it to Spain, which is the largest LNG import capacity of any country in Europe. There's it's clear that the country is now trying to resolve these issues, and of course it's as Fernando says, big opportunity for gas, because the German government is leasing 5 FSRUs, the floating storage and regasification units. They already have two LNG import terminals in Wilhelmshaven and Brunsbüttel. So they are extremely late to the game, shall we say? But they are trying to patch up their pretty glaring weaknesses on LNG import infrastructure. So yes, gas is clearly will be a winner from this.
Salih, I want to get your perspective from the Middle East. I know you've been jetting around to a number of conferences and speaking engagements there in the region. We generally talk about your outlook for the oil business, but how excited are folks in your part of the world about the opportunity for gas, and what do they make of this kind of decision making from Germany to close its nuclear power plant?
Thanks, Rob. I think they are increasingly getting excited about the prospects of natural gas. We know Aramco has big projects. We know ADNOC has just listed its gas unit, ADNOC Gas. And I think back in February, they had the first deal to actually export LNG to Germany, which would have been the first LNG that Germany gets from the Middle East. And I think a big driver for kind of increasing their focus on gas is because the region is obviously known for its oil, and generally oil is a much more lucrative business for them. But what they're trying to do is increase their non-associated gas production and then change their domestic infrastructure so that domestically they're using a lot more natural gas, which actually would allow them, which would actually free up a lot more crude oil for them to be exporting rather than using domestically. So again, I mean, ADNOC Gas just IPO'd. It actually did pretty well on the day of the IPO. It was only a few weeks ago. I mean, Aramco is getting quite serious. They say by 2030 they want to increase their non-associated gas production by 50%. So yeah, I mean, they definitely seem to be on the camp that thinks, you know, natural gas is very much going to be a bridge fuel. Demand will increase in the mid to long term. So they are increasingly betting on it. And this massive project in Saudi Arabia, I mean, it's a $100 billion project by some estimates. So it really kind of gives you an idea of how massive of a natural gas project that will be.
Well, so natural gas pricing is a very interesting phenomenon. I always have to make sure that I'm not doing the conversion wrong. But here in Europe, TTF gas is about $13 per MMBTU versus 2 and change for Henry Hub in the US. And so I wonder out loud a little bit, and I want to come to you for this, Patricio, is just with gas that expensive, is it really going to be economic to use it in the power sector, particularly when you look at the cost of wind, solar, and other technologies, obviously not dispatchable resources, but have very favorable cost profiles these days. So what's your make of the next few years? Are we going to see declining gas use in the power sector? Are we going to see it hold steady? Is it essential?
Sure. I think yeah, let's tackle that in parts. I think policy is key. We cannot ignore policy. I think that's the key part, because right now, as we speak, burning gas versus burning coal is in close competition. So what is keeping European power prices above their long-term norm is the influence of elevated commodity prices in general. So, and what dictates the competition between these two fuels is carbon pricing. So the carbon permit market will also play a role, and the amount of allowances. But if we take into consideration what the set policy is, the longer term policy is that burning coal will become increasingly more expensive, which means there is a future for gas, albeit diminishing in the longer term, as other technologies such as wind and solar, which are by and large the one favored by European policies, and also in the US. It's also a matter of policy and tax credits will make these technologies more economical. So definitely there will be a diminishing share of gas in the power sector, but at the same time, I think it's important to note that perhaps eliminating or reducing the share of gas in the power mix is the lowest hanging fruit in terms of ways of diminishing the share of gas we use overall, given that, well, if you look at gas demand, it's roughly split into three silos: it's industrial, heating, and power sector. And in the power sector is where we see the potential to reduce the most, given that there's no proven alternatives for heating. So hydrogen, I think it's still in an early stage. There's no sort of proven pilots that lead us to think that hydrogen could become a source for heating. I think industrials, it's somewhat still at an early stage, but with promising potential. But I think in the power sector, it's pretty sort of clear to say that the wind and solar bandwagon is it's left the station. Like this is already a happening trend. Most of the European utilities here which account for roughly 20 to 30% of gross installations of wind and solar, keep investing in wind and solar, and this is by and large the biggest share of their capex mix.
Patricio, I got a follow-up question for you. There was an article on the terminal this morning that referenced a new report from Germany's gas storage system operators, and they said under a worst-case scenario the country could run out of storage by January under worst case scenario. So is that possible? And what does the world look like if that actually happened?
So I think our base scenario is I would believe nothing close to the German regulators' worst case scenario. I think pulling the levers in our model shows that, like Fernando mentioned, we did get lucky. So if we consider we have sort of a regular temperature, or let's say temperature in line with the long-term average, which would add approximately 20 billion cubic meters of demand this year alone. And at the same time, Russia decides to cut flows via the two pipelines that are remaining via Turkey and Ukraine. Then those two things would take us to somewhat lower below norm storage levels by the end of March of 2024. That said, we don't see those. Well, obviously, weather is impossible to predict, but on the other front, considering we have Russia keeps on sending those nominal volumes, which are now at about 25 BCM for 2023, which compares to about 400 BCM, which we had in 2021. You see, we kind of cut the reliance on Russia. It wouldn't matter too much, considering that the major LNG portfolio players, so the BPs, the Shells, all the big trading companies have spot volumes of over 40 BCM for 2023, according to our analysis. So that means that there is no sort of we don't see a big risk of having gas shortages, but we do see an upside risk for prices, especially moving into the second half of this year. But that will be mainly competition against Asian buyers, depending on how much the demand uptick is there. And it's also important to consider that Europe does not have a large share of long-term contracts, which means that we would need to keep outbidding other competitors, mostly Asia, given that most of the contracts are geared towards Asia.
Fernando, I want to bring you back into the conversation. I think you and I had a fun little mini debate on Twitter earlier this week about, the kind of trade-offs between energy transition, wind, nuclear, all these sorts of questions. Now, I don't think any of your companies are likely to enter the nuclear space anytime soon, but when you look out at the sort of 5 to 10 year time horizon, it seems that it's very prudent and likely that a lot of companies have at least some portion of their strategy being dedicated to energy transition. Now, how they define that is different for every country or every region and even every company. So what's your latest read on how this kind of question is going to play out for the companies under your coverage in North America? What does energy transition mean for them? Presumably not nuclear.
Yeah, but definitely not nuclear for any of them right now. I think there's a contrast between what they plan to do and then where policy, especially under the current administration, is. Exxon and Chevron have gone towards hydrogen, carbon capture, and then biofuels. And then you see, for example, that the EPA a couple weeks ago put a new proposal out that would cut tailpipe emissions essentially by almost forcing nearly 70% of the car sales by 2032 to be EVs. And that would bypass all the investments that are currently being made in liquid renewable fuels, including ethanol, renewable diesel, and others. Issue there, of course, is the supply chain. Under the Inflation Reduction Act, a lot of it has to be reshored. Consumer preferences also play a role in this. We just saw the latest numbers in Europe, actually, which obviously leads in energy transition, and ICE vehicles, despite all of the incentives, grew way faster than electric vehicle sales the past year. Here, it's even more difficult. There's no charging network. I have serious doubts about hydrogen and its ability to actually be a transportation fuel. It's a very difficult molecule to transport, to store, and to use in cars in general. And then there's just the cost aspect of it. Again, Patricio was referencing what's happening with natural gas. If we have such a move here, it will make it increasingly difficult for, it creates a cost issue. It does raise fossil fuel costs, but it raises the cost of everything else because our whole economy is still based on fossil fuels. And you would have a challenge in reshoring a lot of these battery and mining companies back to the U.S. if we have higher energy costs here, as we're seeing in Europe. And so I think ultimately they're going to stick to carbon capture as the main avenue, hydrogen, and then for some of them renewable biofuels secondarily. It depends. We'll see whether the EPA policy actually gets a lot of pushback. There will be a hearing in early May. That'll be very interesting because obviously automakers, equipment makers, and refiners will have a say in it.
Will, I want to come to you and get your perspective. A number of your companies have been investing and scooping up electric charging infrastructure type companies. So maybe they've got a slightly different take on the role that EVs are going to play here in Europe. But what do you make of the energy transition question here for your coverage, and specifically on the idea of EVs and the role that they're going to play in the light duty segment?
Yeah, so I think it's quite clear that there's a pretty big divergence between energy transition strategies of the European majors and the Americans. We've seen a much bigger focus and move towards renewable power, building out these pretty large portfolios, particularly among Shell, BP, Equinor, and Total. Most of them are weighted to solar, but their targets are anywhere from 50 gigawatts to 100 gigawatts by the end of the decade or shortly thereafter. And although we've seen some indications of a slowdown in these energy transition strategies, namely from BP saying they're going to moderate their decline in oil and gas production volumes, which they had previously signaled at 40% lower by 2030 versus 2020, and they've changed that to 25% now. And this was received pretty positively by the market. It's a good indicator for higher returns, and that will almost certainly sort of percolate down into distribution policy as well. We've also heard some indications from Shell that they're considering doing something along the same lines as BP, sort of slowing that decline of their traditional business. But yeah, extending down the electricity value chain has been a core component of these strategies. This is quite clearly to try and bolster the what you could call lackluster returns of renewable power, which the latest generation projects are anywhere from 6 to 8% IRR, which compares to the hurdle rate for oil and gas projects at 15 to 20. So it's clear that these companies are trying to own everything from generation all the way down through to distribution and customer touch points to try and leverage these returns as best as they can. And EV charging networks will represent a part of that. I think it's also important that longer term, looking at some fuels demand, I think some of these companies may be trying to show an early stage in mitigating the impact on what they call convenience and mobility segments, which are relatively meaningful as far as earnings go. Not just because of the fuels, but also for all the food and snacks and cups of coffee that that these companies sell at their hundreds of thousands of service stations. So EVs will be a big chunk of these segments moving forward for the European majors. I would strongly suspect to see more transition type deals in the future for the European majors.
Cool, thank you, Will. There's a question in the chat that I'll personally take unless anybody else wants to take it. So the question is, what would it take to get policymakers to change their view on nat gas for electric generation? How does the grid maintain reliability without nuclear or natural gas? I mean, look, I think at the end of the day, you've got to price in the market the outcome you want to have happen. And so generally, when we've talked about electricity markets, we're talking about the energy market. That's the real-time market. And when we talk about wholesale power prices, that's what we're referencing. So wind and solar, they can provide energy into the market and they can participate in that market, but they generally don't provide what would be called capacity. And so for systems to get it all right, you want the energy, but you also need capacity to make sure you have reliability. So nuclear, gas, coal even, or batteries perhaps even can provide capacity, but generally you don't think of wind or solar as providing capacity. So you got to price all the things you want. ERCOT, the Texas electricity market, is well known for not having a capacity market. So I think there are things policymakers can do, but in general, that would be one way to do it. Or you could go back to classic command and control regulation, and you tell the local utility, keep the lights on or else. So Salih, let's come to you. We've got a little bit of time left. I know you have been looking at a number of things related here to the oil market lately. I see we're at $83 a barrel today, roughly. So, what do you make of where we're at? And I know there's been a lot of efforts by OPEC Plus to kind of rein in things on the supply side of the equation, but are their efforts working?
Yeah, I would say so. I mean, before that surprise cut that OPEC Plus brought a couple of weeks ago that we talked about in the last call, I mean, we were at much lower prices. I mean, Brent was very close to $70 a barrel. So in that sense, I think those cuts have been pretty effective in bringing fundamentals, which most people seem to agree are quite tight. I mean, looking at the second half of the year, we're really expecting a very tight physical market. It's really, those cuts really brought those back into center stage versus perhaps some of the macro fears that the market perhaps had. Because of course, I mean, about a few weeks ago, there was a lot of concern around the contagion risk from the banking turmoil. That seems to have been contained now. But there's a general recession fear that the market had for a little bit longer, which I would argue is still an overhang on prices. So I think, yeah, pretty much every agency out there, including OPEC themselves, including ourselves, have a constructive outlook for prices in the second half of the year. But despite that, I think those macro concerns kind of outweighed that of a constructive fundamentals outlook. But I think OPEC brought a reminder of how things might look pretty soon in the market. So again, I mean, we were even at higher prices, I think, earlier this week. Brent was closer to $86 a barrel. So it's really going to be, OPEC taking this defensive stance versus, I suppose, the Fed and general macro developments in the rest of this year.
Okay, Salih, thanks for that. I hear your optimism about 2H, but I do recognize that this is going to be probably our last call before the 1Q earnings season kicks off. So maybe we can just do a quick round robin, kind of 1 minute each. Salih, we're going to come to you first. What are you expecting for the 1Q readout for your coverage?
Sure. I mean, we were just talking about this with Will before the call. So we're looking at some of the European integrated names or European majors. What we're seeing from their earlier trading updates is that refining margins are actually proving to be quite resilient, broadly stable, or in some cases even higher than the fourth quarter. I think that's mainly due to this tight diesel market, tight middle distillates market that they are benefiting from. In terms of benchmark pricing on the upstream side, it's been down a little bit, but not by much. And I think for the rest of this year, upstream will do a little bit better given the outlook for the benchmark prices. So very briefly on the major segments, that is upstream and downstream, it looks like it's going to be another decent set of results for the European integrated.
Will, over to you next.
Yeah, not too much to disagree with there from Sal. I mean, from what we've seen from the trading updates, pretty positive. I'd keep an eye out for trading and optimization results from Shell. They signaled that they could have another exceptional gas trading performance similar to 4Q. This is complemented by pretty strong operational signals as well in their integrated gas unit. So yeah, we see another pretty strong quarter ahead with likely maintenance of buyback tranches that we saw in 1Q.
Fernando, over to you.
Yeah, on the integrated side, we think they'll still generate excess cash flow. Buyback targets, which were pretty lofty, will probably still be covered. Same on the refining side. The one caveat I'll say is that refining margins are starting to show weakness for the second quarter. So one black eye for the sector is that we'll probably see some negative earnings revisions for the second quarter and beyond that. And that may just take some of the positivity away from the sector.
All right, Patricio.
Sure. I guess, yeah, my industry is a bit less, less exciting in this sense. But what we expect for first quarter, I think, is first of all, I think the overarching trend is that we don't expect to see sort of the same earnings exuberance that we saw during 2022, given a lot of the independent power producers did benefit from the energy crunch in Europe. So we see results somewhat normalizing in the first quarter. And I think the big theme in terms of technologies that are going to be dominating the power mix will be how do the companies fare now that there's no gas price upside in their earnings. So this places more attention on the execution of their capex plans, their renewable projects, and also seeing evidence if the returns on the renewable front are somewhat stabilizing. We're also focusing on improved wind speeds here in Europe. We expect to see wind focused operators to have a relatively good quarter. The same goes for Southern European utilities, which faced adverse hydrological conditions for the better part of last year. We do expect to see a recovery there, and an overall decline in power sourcing procurement costs, meaning what you were talking about, Rob, with the wholesale power prices, they have come down a lot, meaning that the input costs for many of our companies have gone down. So overall, it's an extension of a defensive, albeit moderating, earnings cycle, I think.
Okay, and for anyone who's following the wind and solar space, we've got First Solar and Enphase coming out next week. I would be looking for very strong double-digit sales growth that is profitable. So let's see how it turns out. Make sure to check out our previews on all the companies. If you don't know it, we write previews ahead of every earnings cycle for all the companies we cover, and following the earnings, we write outlooks for what we anticipate could occur next based on what we just heard, and we update all of our primers. So if you're unfamiliar with any of that work, please make sure to reach out to us so we can show you where it lives on the terminal. For anyone who missed it, Salih and Fernando had an in-person meeting in New York just a few weeks ago, and shortly before that, myself and Scott Levine did an event in New York as well. So we are not only doing these virtual conversations, but we are trying to get out and see you in person. So if you haven't met us and you want to say hello, you know, shoot us an IB. You're welcome to stop by the office for a coffee one day, or we can, if there's enough of a quorum, we'll get a larger group together. I want to thank you for your time today. Make sure to reach out to any of us if you have follow-up questions, and we look forward to being in touch, and we'll see you on the first Wednesday of next month.